Hi, I'm Richard Purnell from the Mortgage Home. We are your buy-to-let mortgage experts, and this is your February 2022 mortgage update. Where did the time go? Let's jump straight into Market Watch. This has been the headline for the last 3 months now. Bank of England, as you know, the rates have gone up yet a little further, another 0.25% to 0.5. So what does that mean for you guys? What does it mean for mortgage rates? Well, it's a tale of two halves, really. First of all, if we focus on the high street banks, so you can see on my second bullet point here, I've highlighted four big high street lenders. And yes, the rates are starting to go up now. And that's happening across nearly all of the buy-to-let deals that are being offered by the high street banks. And that's because their source of funding and the way that they operate financially, there's a direct link to the Bank of England. So if the Bank of England sneeze, the mortgage rates catch a cold in essence. But, a little bit of good news in there, in that rates are not going up by the full margin, that 0.4% of an increase that we've had on the Bank of England rate over the last 2 months. The full 0.4 is not yet being passed on. So look, but it's on the rise. So that's the first thing. I say it was a tale of two halves. So when we're focusing on lenders who are not high street banks, so I'll give you a few examples: Aldermore, Precise, Kensington, the mortgage lenders, Zephyr, to name but a few. These are not high street banks. So therefore, the way that they're funded is completely different to the banks. And therefore, they're not under the same influence when the Bank of England starts to put rates up. And in fact, we're seeing an exact opposite happening. Because of the way they get their money from the wholesale markets, they're now starting to see that they can get rates slightly cheaper, and that savings being passed on to you as landlords. So would you believe, despite the Bank of England going up, we're actually seeing not massive, and we're not going to throw parties here, but we are seeing rates starting to drop. There's more competition for your business. So actually, it's a little bit of good news in there. One area I looked at, HMOs. You can see on my third bullet point, the mortgage lender, that's TML, Vida, Paragon. They've just relaunched products this month, and their rates have dropped across all the HMO branding. So that's it happening in practice. Now, what I did also do is look at how many lenders now are offering HMOs and what are the lowest rates out there. And this reflects the competition that they've got for your business. Today, at the time of recording, what are we on? We're on the 17th of February. There were 7 lenders offering HMO deals under 3%. And I've not seen that for a long, long time. So really encouraging, really good news for you guys that have got HMOs, but it does spread across the whole buy-to-let product matrix when we're talking about lenders that are not high street banks. So if you're a portfolio lender, it's your brokers likely to be knocking on the doors of these guys anyway now, because the high streets don't like you portfolio guys. So you're going to be gravitating more to these secondary lenders. So, there is some good news in there. Last bullet point on this, can't spend much time on it as I've got a lot of fit in today, but can you get a HMO deal at 1.57%? If you listen to my January mortgage update, I covered it there. And I've looked today, those deals are still there, but there's hoops to jump through. Check my January mortgage update to see what those are, or give us a call and we'll have a chat with you and see actually for your HMO, you might actually be eligible for an absolute cracker. Okay. Something that caught my eye was Skipton International. It doesn't matter really about the name, but they're quite a big player when it comes to offering mortgages to expats and to foreign investors. And they've come out with some stats that said that their demand for their business has doubled in the last year. And it made me think, because it's an area we also specialize in as a brokerage. We work with quite a few expats and a few introducers that focus particularly on expats, as well as foreign investors themselves, whether it be Middle East, Far East, and other countries. So we're seeing the same thing now. Now, why would that be? Well, certainly now we're through Brexit. Obviously, choppy times, so much uncertainty. That would have been one issue. We're now out the other side of that, whether we like what world we're now living in this post-Brexit setup or not, is by the by, but we are there. So we're now seen as a safer country to invest in. And I think relative to property markets abroad, yields are really strong in the UK. So you've got this combination of factors that's driving investment over here. In addition, we also get a significant amount of inquiries. So I'm just wondering whether you as landlords, if this is happening to you as well, if you've got contacts, links over in Hong Kong then, you know, clearly we've all seen it on the news over the last sort of probably 12 months or more, with the Chinese government trying to impose their more traditional communist ways on Hong Kong. And so that's driving a lot of the money back out of Hong Kong, and a lot is coming to the UK. So I'm seeing, when it comes to joint ventures in particular, and I'm going to cover actually a little bit more on joint ventures today, that it's a real complex area. If you've got a UK-based landlord wanting to do some sort of property project with a foreign investor, whether it be Hong Kong or otherwise, but the message I want to give out today, because we clearly have time to go into something that's a complex subject in its own right, is that yes, there is finance available for that type of scenario. If you want to get into buy-to-let, holiday-let, then there are lenders in the UK that have appetite to lend to that type of situation. So yeah, do get in touch if it's something that you're considering doing. Finally, on this page, caught my eye today actually, Accord Mortgages. Now they're the intermediary arm of Yorkshire Building Society. They've launched this 5-year fixed with no penalties. And it always puts a smile on my face when I see lenders release a product that has no penalties, because I know why it appeals to you landlords by a country mile. There are other reasons why you might want a buy-to-let deal with no penalties, but the main reason is you're probably going to flip it. Now, if you're getting a mortgage at the point of purchase, of course, the property you're buying has to be lettable. Can't be a project property, otherwise you're not going to get a buy-to-let mortgage on it in the first place. That's bridging, development, or some other form of short-term finance. But assume that the property you're buying is sort of fit for letting, and you're thinking, okay, well, I'm going to do some upgrade, I'm going to decorate it, it's looking tired, I'm going to change the carpets, I might change the bathroom or the kitchen, because again, I think I can, you know, sell it at a higher value. It's worth me doing that bit of work. But from a lender point of view, they think it's lettable straight away, so they're going to give you a buy-to-let mortgage on it. So the biggest reason you guys get this type of mortgage and no penalties is because you ain't going to let it, you're going to flip it. But here's the rub. If you say that to the lender, whether that's Accord or any of the other boys that offer mortgages with no penalties, they'll decline you. Contradiction. So be really careful about what your intention is and speak to your broker, because if you try and do it yourself, or a broker somehow says that actually the plan is to do some work and then sell it, they'll say, well, that's not the purpose of a mortgage. It is a long-term product, but yet they're offering it with no penalties. So it is a contradiction. I get it, but be really careful about that. Okay. I want to move on to an area that we still get asked about on a really regular basis. And by the way, I'm really going to zip through this bullet points today. But if you want more information, you've two options. If you go onto our company website, www.themortgagehome.co.uk, we've got more information sheets on buying in a limited company that will help you. If you want to get in touch and just have a chat about your situation and what you're proposing, then we'd be delighted to try and throw our 2 pence in the ring. So here's the main queries that we get when it comes to buying in a limited company. I've already got a limited company. Why do I need to set up a brand new one? It's going to cost me to set it up. My accountant says he's going to charge me more money. So why don't I use my existing trading limited company? The simple answer is yes, you can. Yes, you can. But when we look at the number of products available for whether you're buying using an existing trading limited company, let's say you run a plumbers or some other trade, or you're an IT professional and it's all in a limited company, yes, you can get your buy-to-let in there, but probably by a margin of 4 or 5 to 1, the choice of products available to you are that much higher if you set up a brand new, clean, limited company, otherwise known as SPV, special purpose vehicle. So lenders are trying to drive you that way in the first place. So again, speak to your broker. Let's go through the pros and cons. Let's see what deals you can get in a trading limited company if it makes sense for you to keep everything there. But if you're just thinking, look, that's where all my profits are, then actually you can do intercompany loans out of your trading limited company into the SPV. I've got actually on the last bullet point. Clearly, you've got to speak to your accountant to make sure that they're comfortable with that. But that could be another way of just moving money from one limited company to another. Also, actually, setting up an SPV, your accountant probably won't like me saying this, they will probably charge about 400 quid to do that. You can set them up yourself for £13. So, you know, there is a cheap and cheerful way of doing it. But your accountant will probably give you good reasons why you should go through them. Shareholders gets really complicated. Probably the main thing I see that can be an issue is if you try and put your kids on as shareholders. I get that probably not one of the main reasons, but a popular reason why you're setting up a limited company, not only for tax mitigation purposes, is that legacy, that long-term goal of yours to be able to pass on those assets down the line. And yes, in a limited company makes that a little easier, but you've got to speak to your broker now about whether the theoretical benefit, and it can be driven by your accountant quite often, to bring other people in as shareholders, because there's also tax benefits right now. You know, you get some dividends out tax-free, so quite often your accountant is pushing that. They'll probably talk about alphabet shares to put more and more people on there, so it's a real good way of getting profit out of the company cheap. And I get all that, but that's an accountant talking about how to minimize tax. You have to marry that up with the practicality of lenders lending to that type of limited company. So again, without spending too much more time on it, if this is you and you're thinking about setting up a limited company, it needs to be a three-way conversation. Get your accountant, your broker, and yourselves all on a call, a Zoom call, so that between us we get that compromise that means that it balances the tax mitigation with the practicality of all the deals that you need, so that you're competitive in terms of getting rates. Quite often you guys are setting up limited companies because you've got JV partners, you've got people that want to perhaps usually they want to put money into the deal. You're perhaps the one with the experience and the time, and so they're putting the cash in. And so how are they going to fit into the limited company? What shareholding are they going to have? Do they need to be a director or not? What's the pros and cons of that? Again, same thing as I said a couple of minutes ago. If you talk to your accountant only and agree the right model and the right setup for your limited company, and then you come to us as brokers, sadly, too often I'm having to get you to untangle it, sometimes even throw that limited company in the bin and start again, because it's easier to set up yet another one. So please talk to your broker when you're thinking of setting up a JV, whether that's someone in the UK or, as I mentioned a little earlier, someone abroad. Directors, this is an easy one. All directors need to be on the application. So think carefully when you set up a limited company who you set up as a director, because they have to be party to the application. But will they be eligible? Have they got adverse? Are they under 21 years of age? Things that would really cause issues in you actually getting mortgages. So think about who your director is going to be. And actually, I think this is probably a real practical thing from the lender's point of view. They don't want more than 4 directors. I think really is the systems side of things that they can only cope with 4 applicants. So if you have a company, let's go back to that top bullet point of a trading company that happens to have 5 directors. Remember, all directors have got to be on the application. you probably find very, very few lenders who will be able to lend to you because the systems don't cope with 5. So again, the theme of this page is really the talk to your broker in the plan and preparation side of it all. In terms of getting money into that limited company, the usual way is through a director's loan. You know, you're lending money to that limited company, and it sits there. And of course, when the company's making profits, you're pulling it out tax-free to essentially to repay that original loan. And as I said earlier, intercompany loans acceptable to most lenders, not everyone. So again, tell your broker how you're intending to get the deposit into your limited company, because if it is intercompany loan, there will be a smaller number of lenders that don't actually deal with that. And so if your broker hasn't picked that up and it comes out at the 11th hour, that's embarrassing all around when you've got to start again. Okay, that's the mortgage side of things done. I do like to talk a little bit about protection, whether that's life insurance or in this case, I really want to cover off income protection. Who does this appeal to? Who's it going to benefit most? Well, the first category are people who are employed, but do you have a company sick pay scheme? Now, if you're listening to this and you're going, frankly, I ain't got a clue, I haven't been off sick for a number of years, well, you've got to dust off your employment contract or speak to your boss, of course. Although that might worry them if you want to know that. But anyway, find out what's in that contract. And it wouldn't surprise me, particularly if you're employed by a smaller company, that you don't actually have any company sick pay scheme at all. It might say that once you're off sick, you're going straight onto statutory sick pay, which I don't have the exact figures in front of me, but I think it's about 90 odd pounds a week. So, you know, can you survive on 95 quid a week? And if so, how long? Have you got savings? How long would the savings last? And these are the really pertinent questions you want to think about. So if you're employed, if you're in the public sector, and if you're not, you're going to get really wound up at this point, because pretty much everyone in the public sector can have 6 months full pay, 6 months half pay. They've got one of the best sick pay schemes in the UK. But in the private sector, voluntary sector, smaller businesses, they tend to have either just maybe a week, 2 weeks at full pay, and then you're straight onto SSP. So it's you guys that are vulnerable. And particularly, are you the main wage earner or the only wage earner in the household? So therefore, you're the one that's at risk. You've got very little sick pay from your employer, if any, and you're going to be relying on 95 quid a week SSP. So if that's you and you're really at risk, you really need to be talking to us or insurance advisor about what income protection is, how can it cover you, what are the benefits, of course, what are the costs. Here's another thing. So many times we speak to people that are self-employed, whether you're sole trader, partnership, and this type of policy applies to you guys as well. Of course, you've no sick pay scheme. You're self-employed. So you could potentially be more vulnerable, again, depending on what savings you've got to fall back on. But, you know, usually savings have only got a certain lifespan. The good thing about these types of products, let's say you've got savings that are going to cover you for 3 months. Well, that's fine. That's going to cover most accidents and sicknesses. But, you know, what if? And when you're having these conversations, you want to be plan for the worst and then hope for the best. So planning for the worst. What if you do have a cancer, a heart attack, some real long-term life-changing situation? 3 months worth of savings? Well, what's going to happen in month 4 then? You're going to have to be selling the home. What's the plan? Okay, you don't have one, right? Well, that's where income protection comes in, because, and this is where it becomes really cheap, because income protection can start in month 4 of any illness or accident. Or if you've got savings for 6 months, it can start in month 7. If you've got savings for 12 months, it can start in month 13. And these policies, once you do start claiming, you can claim, let's say you're unable to work again. I'm going to talk about how do I claim. I'm sort of jumping around a little bit on this page, but But let's say you can never work again because it is a life-changing condition you've had. So these policies will kick in, let's say in month 6, because you've got savings for 6 months. So they kick in, sorry, month 7, and they will continue to pay you an income if you never went back to work because you are not fit to go back to work until retirement. Is that 10 years, 20 years, 30 years? Doesn't matter. They're really high quality policies. The last thing I want to say on here is about how do I claim, because you might be thinking there's a lot of people that until they understand these policies are a little bit cynical about insurance companies, and they might be thinking, yeah, well, what hoops have I got to jump through to even claim? I bet it's got to be a certain condition. Oh, have I got to have had an accident or an illness at work to be able to claim? No. You're covered 24 hours a day. It doesn't matter whether you're at work, at home, irrelevant. Well, what condition do I have to have had to claim? Doesn't matter. Irrelevant. Any accident, any sickness. Here's the simplicity of these types of policies. The ability to claim is you going to your GP and your GP saying, do you know what? You are not fit for work. I am signing you off as unfit. And that is your eligibility to claim. And it's as simple as that. So please, if this resonates with you, if you don't have any cover, if your company sick pay scheme is really minimal or doesn't exist at all, or you're self-employed and you've got some but limited savings, then it's something you really should be considering. And it might even be, something that you could pay the premiums out of the business. So again, get in touch if you want to understand a little bit more about how that works and how it could benefit you. And then just to wind up, here we are, list as usual of all our services that we offer. So if you're thinking of purchasing any of these types, it's all in the plan and the preparation. Do have a chat with us. We'll let you know if it's achievable, how best to structure it, what the sort of deals are. We'd be delighted to have a chat. And of course, these are the ways of getting in touch. So cut and paste or type that into your browser and you can organise an appointment with one of the team, and they'd be delighted to help if they can. So look, that's the February mortgage update for this month. Thank you very much for listening to them. Really is appreciated. Please give us any comments, any feedback. Are there areas that you want me to cover off in the next update that you're really interested to know about? I'd be delighted to tailor the things that I cover to those that are viewing. I really want to thank you for listening right to the end. And if you want to be notified in the future, there'll be a subscribe button just around the side of this periphery of this video, and do like it as well, so that I really want to get some feedback and tailor what I'm doing so that you guys get some benefit. Other than that, have a great month, and I'll talk to you again in March.